Inside Commercial Property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
G'day, hey guys, Phil Tarrant here, guys, the co-host of Inside Commercial Property. How you going? I'm recording from Melbourne, doing some on-the-ground truth, working out what's happening with commercial markets down here, and I'm sitting out looking over the Docklands in a moment. I have a couple of observations. I've been here for the last couple of days. Number one, it's a soulless place. Number two, you can't get a kebab at 12 o'clock at night when you really, really need one. And number three, I really think the amenities of this place is pretty poor. Looking out over the water here, and a lot of cookie cutter apartments, resi apartments. But it's interesting. It's got a straight line into commercial property, so it's a real microcosm of probably markets right across Australia, where walking a couple of blocks completely changes the footprint, the asset classes, and how people can invest in property. But I reckon there's a lot of people that bought property down here in Docklands many, many years ago, and they're still probably sitting around, even though property's gone up by a significant amount of money over the last few years, sitting around still waiting to get the money back. But that's more of a resi property discussion. We're here to talk about commercial property. Joining me, Scott O'Neill, Director, Rethink Investing. How you going? That sounds like a Kiwi, investing. Scott, how you going?
Yeah, very good, mate. Nice harsh start for the Melbournians this morning. So, yeah, mate.
I know, it is.
Got a few Melbourne people that work for us. They wouldn't be happy, but got to have a bag, don't you?
Yeah, you do.
Conflict. I love it.
Oh, yeah. Look, it's okay down here. Did you ever buy an apartment in Docklands?
No, mate. I avoid the high-rise units with all at any cost, really. Never really saw it as an option, but yeah, nice shiny off the plan. It does suck a few people in, doesn't it?
Oh, it does. And you can come in and there's I don't know how many of these big high-rises there are down here. There's a concierge person, there's a pool, there's a gym, there's lots of car parking. It's you could live here, but I just think you'd be pretty bored. There's not a lot to do. That said, there's train junction. What do you call it? Tram junction right down here, get you into town pretty quickly. If you're a young executive working 70-hour days in the city, probably makes sense. I get it, but whether or not it's an investment property, I'm not too sure, mate.
Yeah, and definitely, look, we're not really big in the commercial side of things down in Melbourne, and really it's just because of the yields. Like, it's got the lowest yields in the country, and there's it's hard to explain why. We've kind of brought it up before and in other media sources. It seems like it's almost a culture thing. Like, there is a greater buyer sentiment versus renter sentiment down there than Sydney, for example. That may have a little bit to do with the prices, but it really does drive yields down when you've got slightly more buyers versus renters. It's culturally you can accept a lower yield than you would anywhere else in the country. So yeah, it's not a great place for positively geared property, and hence why my company doesn't really kind of play in that field too much.
That's fair enough. And I've got resi property down here. I don't have any commercial property. But there's a lot of Australian investors now, consecutive rate rises. We're nearing the top of the interest rate cycle. We're at the terminal rate yet. I'm not too sure. There's maybe one or two more 25 basis points increases. A lot of people, a lot of noise now starting to come out around the impact of the cost of living increases, particularly how that applies to mortgages and rents. So renters and both mortgage holders are feeling the impact, and that's very much the goal of the Reserve Bank of Australia to stimulate that sort of activity. They want people to slow down. They want to curb spending and lending to get a hold on inflation, Scott. But this is about commercial property rather than residential property. You can't talk about the two in isolation. They're intrinsically connected and linked, particularly for those people who typically kick off, and we've spoken about it, investing in resi property and then make a shift into commercial property. I own both commercial and residential assets. To me, Scott, commercial property was really attractive prior to these interest rates coming up. I imagine now there's a lot of commercial investors who have got in over the last couple of years who have seen the cash return on their commercial investments be eroded pretty quickly by rising interest rates. If you're a cash buyer in commercial, I think it's good times ahead. If you're smart, proactive, strategic, you can secure really good assets today for preparation for tomorrow. But for leveraged commercial investors, the question is, Scott, is it a good time to be investing in commercial property?
Yeah, really good question. And there's a few parts to it. And high level, it is a very good time because you are going to get a discount than you did last year. It's probably seen a 0.75% basis points decompression of the yield. So if a yielding property was 6% last year net, you're probably going to get that thing at 6.75%. So all of a sudden, that's a pretty good yield. The yield expansions come from two particular areas. One is rental growth. So we're seeing the best rental growth rates in over a decade, and it's really off the back of everything that's going on with the economy. So building costs have gone up. That filters down into less supply. You've got interest rates that have gone up. That makes vendors and owners more, I guess, the probability of them trying to push rents up is higher. So that will actually, over time, push rents up higher as well. Even things like insurance premiums and all that kind of stuff, costs have just gone up. So it all does filter down into the leasing value in time. So that is a really good sign for capital growth, because as you know, for commercial property, the rent is the baseline for a lot of the valuation. So if rents go up, so does the value. So right now we're seeing that rental growth that we so desperately needed over the last 10 years, because all the growth coming out of commercial was really just from yield compression, which is almost like just cheaper money flowing through and inflating asset values, not creating any underlying value. So I like this economy better, although the returns aren't as good. But as you know, interest rates are going to come up and then probably come down. And to illustrate what the market is predicting right now, if you look at, say, Westpac, for example, they're saying peak cash rate is going to be 4.1%. This is Bill Evans, who's a very respected economist, a senior economist for Westpac. He is predicting 7 rate cuts from 2024 as well. So even if half of that's
7
right,
rate cuts.
That's right. So they're going to need to stimulate growth at some point, because this will cause damage. And the rate cuts are predicted to be on the way next year, and not just one of them. He's predicting 7. And yeah, he's one economist, but I think you're going to see that theme come up more and more because, the goal is to bring inflation down. And the way of doing that is to hurt the economy. Unemployment may rise. People might start defaulting on mortgages. And once that all starts happening, it's going to move quite quick. And to stabilize things, you'll probably need to drop rates pretty quickly.
So there's quite a few moving parts there. So this, and I sort of referenced at the top of this podcast, what the Reserve Bank is trying to do is to curb inflation right now, and that's the reason why they're rising rates. We're starting to see the impact. We're getting towards the top. Your point there is that Bill Evans, the Westpac economist, is predicting rate cuts. So what you're saying is that once the RBA has served the purpose of rising rates, they'll bring it back into a more neutral position. It's never going to go back down to 0.1%. I can't see that ever happening again. But your point is, Scott, and I'm just trying to just listening and to summarize that for our listeners. Your cash return on commercial investments, if you're leveraged, is not going to be good. Or it's not going to be as good through this period as we go through this sort of a rate stabilization. However, what you're saying, though, is going to positively reset the value of your commercial assets, because rents are higher, and rents are very much a mechanism for how banks and lenders value your property. So if rents go up, and you need a mechanism for your rents to go up, and hopefully a lot of people, when they negotiate their contracts, there'll be some sort of stepped rent increase through it. And if you're on a CPI rent review each year, that's pretty positive, because it's been sort of 7% or so. A lot of people will sort of factor in fixed sort of 4% inside of their commercial leases. But what you're saying, though, is that mechanism of increasing the rents will support greater valuation of properties moving forward. So your property values are going to hold firm. Is that the summary?
Correct. And not only that, once those interest rates drop, if they drop, when they drop, that baseline rent is now higher. So it's probably going to push it into the highest ever capital value, because now we've got more rental income. So rental income is a long-term growth pattern, which is, it's a slower, it's not like the sugar hit that we were getting in the 2020 to 21, 22, once rates dropped. But yeah, it's real value, and that's going to sort of last a lot longer. And if rates drop, it's going to create very good cash flow for the investors that got in at the right yield at least. And I'm very bullish for that reason. I think it's a good time to buy now because you can get a discount, and it's better than it was last year. You just got to look past the returns, and the returns are still pretty good. Remember, you just got to accept a decent day one yield. Like, I'll use a real quick high level example. Like, excuse the number, it's just one of the last deals we did. It was a $3.864 million property. It was a 6.5 net yield, so that's 250 grand income, 70% debt. At the current interest rate, which was about 5.6 for the client, he was going to clear $101,000 with that. Now, if you scale that back to what the interest rates were last year, let's say it was a 2.5% interest, which they were, the income of that would have been 180,000. So it's dropped from 180 to 110. Now, there is a cash component in this. It's 30% cash. So not everyone has that for a big deal, but that's a pretty good return on investment. Like, you're still positively geared, and that's why you're not seeing the commercial markets fall at the same rate as you are with residential, because I'm not seeing anyone go under. Like, it's hard to go under with commercial property unless you've got no tenant, because if there is a tenant there or multiple tenants, then your interest is getting covered. And some may argue, well, what if it was 100% debt? You're still, unless the thing was under your interest rate, which, it's 5.6%. So unless you're going out there and buying a 3% yielding asset, which you'd be crazy to, again, you're gonna even break even as long as you're hitting, just aim for over 6% and you're good. And then once the interest rate dropped, there could be some yield compression, and that rent just keeps growing each year as well. So if the rent grows 5%, you've got 5% extra capital value, assuming the cap rate of the market is the same. So it's not a bad story. The equation stacks.
So I've been chatting with a lot of property investors and sort of, coming secondhand through different channels that I'm sort of connected with. And there's a lot of really concerned punters out there. They got the jibbers with, their ability to continue to grow as a property investor because they're committed into significant debt inside of a commercial asset, and it's decreasing serviceability. There's also people who have lease stock type loans, and they're really, really worried about sort of the value of their assets holding up, and the bank sort of saying, you're in pretty significant negative equity here. What do you say to all that, Scott?
Well, it's something like interest rates have gone up, the asset values haven't dropped. They've dropped to remember the yields got a little bit higher, but if you bought into a good growing rental market, then your asset value is almost the same, if not better than it was last year. So the values, and we're not yet to see those negative situations. If you lost your tenant and you revalued it at that point, there would be a situation of a negative equity while there's no tenant, there's no income. Banks are not calling loans in. They're actually extremely actively trying to go for market share in this space. So they're going to work with investors, particularly commercial right now, to acquire them and take them from other sources. And it's really reflective in the fact that you don't have to pay application fees and stuff like that with commercial. Like, I remember one of my commercial properties a few years ago, I had to pay $70,000 on an application fee. I got a larger loan 3 months ago and I paid zero. So the banks would never have waived that fee if they didn't want me as a client. And when my clients sort of asked, should we pay application fees? The answer is no. You should be pushing back on your bank. Maybe even run a tandem finance process if you are purchasing, so you can avoid that cost. But yeah, it's a pretty healthy market. You just got to be wary of, there is a two-speed commercial market, because the lower yielding assets, if you went and bought a service station at a 4% yield last year, that's not a good situation, because the demand for that lower yielding asset is now significantly lower. But if you bought a 7% asset, like for example, the one you bought in your super fill, that would have more, I think even more buyers than it did last year. Like we're seeing our volumes in our company, like we did 48 properties in February. Like that's one of our busiest months. So the demand is there, but people are shifting towards wanting higher yielding assets. There's no scooting around that fact. There's there's definitely weakness in the lower yielding markets, and you can see it with the auctions that go each month with those major sales companies. You can see the yield expanding under their feet, and because investors can't accept lower yields, and that's probably where you're going to see those negative situations.
Yeah, and I think that's something we should keep across and on top of. And if anyone's got any questions, but whether it's generic or quite detailed, we're happy to answer them on Inside Commercial Property. Scott, what's the best email address for people to contact us on?
info@rethinkinvesting.com.au.
That's the spot you need to be. Now, you mentioned investing in your SMSF, Scott, and in markets like this where you do get some compressions on cash flow, and depending on the asset class you're working, it's if you're investing inside of your self-managed super fund, and this is not advice in any way whatsoever, it's just a very generic conversation around it, but it's a little bit more forgiving investing inside of your SMSF. It's isolated, and you have this sort of two-speed, I guess, market of contributions coming through by way of rent, and also contributions by way of your superannuation contributions. So that sort of level of isolation sort of supports negativity in cash flow, should you find yourself there, Scott. But this is sort of politics meets commercial property. You see the Treasurer is pretty active at the moment around superannuation balances and having a good crack at that. Can you see any impact for commercial property for people who particularly operate inside of SMSFs if it's curbed, the amount of assets are able to hold in there with the sort of, I guess, the tax effectiveness of holding assets inside of your self-managed super?
Yeah, look, I think generally a lot of the deals we do in super, under 3 million as well. But yeah, if there is a sort of a cap, there's going to be less properties in super fund purchases. And you've got to remember, a lot of the interest rates you get in these super funds are probably 2 or 3% higher than outside. So, if you are an investor who wants to leverage, which I think any smart investor should, like a fund manager doesn't just buy with cash, you buy generally 55% debt because you can maximize your returns. However, when you've got that really high interest rate in a super account, it does diminish the returns to a degree. So yeah, there's not going to be as much lending, I don't think, in that space. And if the tax effectiveness is not a good over a certain point, then less people will be buying properties in super funds. And if they're playing around with capital gains taxes and stuff like that, that's going to be a further detriment to any asset class. To be honest, it's going to stop investment. Or at least reduce it, but it's a small number of people. Like I heard on the radio, it might be 10,000 people affected. I'm not sure if that fact's correct, but it's not a huge amount in the grand scheme of things.
Yeah, well, it goes to show some of the tinkering you get when new governments come in, and no doubt the current government would like people to be putting their money into industry funds. That's where a lot of it goes, and that's it's good money that's used for infrastructure projects, so everyone wins somewhere in the end. But I don't do it anymore, Scott. I don't even look at my share portfolio anymore. I just put my head in my hand and just shake my head saying, why don't I just put that money in property? Again, that's just my personal view of it. But it hasn't been a great run. But all asset classes swing in roundabouts. Commercial property absolutely being one of them. One of the catalysts for us to create this particular podcast is to have sort of informed discussions around investing in commercial. The point that we made very early on in this series, Scott, was at a point in time, commercial property investors will start considering commercial. Resi would start considering commercial. It's normally around a cash flow yield play. As they get a more mature portfolio, they start thinking about a cash flow management. We're in an environment now where the cash returns aren't as good. So if you're able to keep an eye on your debt levels, if you're able to keep an eye on and ensure you've got the most appropriate rate at any given time to service the debt that you have, with a consciousness that it's going to hamper potentially serviceability. But everyone's getting smashed on serviceability right now, Scott, and hopefully that will ameliorate after rates start coming back to these cuts that you were mentioned beforehand. But there is a lot of cash buyers in the market as well, and I know a lot of people right now with good cash coffers who are out there sort of hunting commercial assets for many of the reasons we spoke about, for long-term cash creation, but also generational cash creation. So that's happening. But Scott, I've seen some deals coming through recently, and they make sort of headlines. And I sometimes sit there and scratch my head and go, I'm not too sure if that's a good buy or someone's paying way overs on this. I'm trying to understand that even if people are cash buyers, securing sort of yielding assets at sort of 3.5%, they've got to be able to deploy their money better elsewhere, would be my view. Are you seeing any of these deals coming over where you just sort of scratch your head and say, I don't get it?
Yeah, and it's quite big in our industry because, we all talk and, there's big auction houses that run and they generally sell those kind of like long leases, safety net type properties. So service stations, childcares, fast food places. And it is actually staggering the prices they achieve sometimes. And as an investor who's a return sensitive, investor, we want good return on money and cash or no cash. Even if you've got 10 million in cash, you should be either splitting it between two $10 million properties, 50% leverage, then you've got 20 million of assets, you diversify, it's lower risk, the debt is twice over covered. And but some people, there's a lack of education. And this is one of my bugbears in the commercial world, because it doesn't happen in residential very rarely, where someone may overpay 30, 40% and have no idea they've done it. But how do you value a fast food place in, regional Australia when they don't sell them often? People buy on a yield at the time, and it's kind of frightening to see people get ripped off, sometimes to the sum of millions of dollars, and have no clue what happened. And then you see the results paraded all over the internet. The service stations sold in West Melbourne at 2.6% yields and stuff like that. And you think, why would someone buy a service station at a 2.6 yield, especially now the cash rate's higher than that? And then it might be a fixed 3% increase. So there's no upside in the rent. There's no upside in the actual asset when you know these assets. It's just a safe play. They look at a lease and they get almost romantic over the lease to go, I'm going to go all in because it's a long lease. And it's a big mistake we see many investors make. And we try to educate them to go, it's not just about the lease, because businesses will come and go. And the lease is, even if it lasts the entire lease, the more experienced investors would almost rather shorter leases, because you can get a better deal up front. And we all know that tenants renew leases as well. So a 3 by 3 year lease generally equates to a 9-year lease anyway. It just comes in portions, but then you get market reviews at the end of each lease. Every time that happens, you could get capital gains as well. So there's been a few recent sales that, you're right, Philip, we've been shaking our heads, and I have hundreds of clients email and go, what was this buyer thinking? And it's sometimes they just don't know any better, and they get, like I said, a bit romantic over a lease and pay a lot more than they should.
So you make an interesting point, that is, you don't see people often in residential investors overpaying for assets. Whether there's a greater appreciation of value, or it's simpler to value properties for residential purposes because you have so much like-for-like comparison in any given area. Back to Docklands, I'm sitting here right now, and I could probably see, probably about 500 sort of villas and a couple of thousand apartments, right? Like there is, and I was actually sitting here sort of scrolling through yesterday price points here. Like, what something is worth, right? If you pay over, you might pay over by 5-10 grand, right? You're not paying over by 20 or 30%. Same doesn't apply in commercial property. It's because some of those assets you spoke about are relatively unique, and hence the reason why maybe that's the romanticism of it, saying, hey, this is such a unique property, it's always going to be valued. I'm happy to pay a little bit over on it. But it's hard to compare and contrast, and that comes down to education on whether, maybe it sort of lends itself to what you do for a living, but it's hard to be an armchair a commercial property investor, where you can look up on realestate.com and go, I reckon that's worth about this, plus or minus maybe a couple of grand. It's easier to get it a lot wrong in commercial property because you need to understand the valuation methodologies and the mindsets around it and the moving parts from it. And that is the capital value of the property, where it is, locational, and sort of stuff. But it's the underlying economics of it, as in how much money does it make? How long is the lease? What is the what is the structure of the lease to support long-term cash growth? And that's a lot more complicated, and maybe that's the reason why people get it more wrong, Scott.
Yeah, and one of my big goals as a professional is just to educate as much as possible out there, because it's not nice seeing people almost get hoodwinked in these situations. Like a Crown Casino auction, and then next minute they've paid $5 million for a small fast food place in Western New South Wales, or out in South Australia somewhere, like rural areas, and you think $5 million, if you actually know what to do with that, you can buy a blue chip asset in the middle of a capital city at a better yield with a lot more upside. And I guess that's my job, to find good investments, and sometimes just trying to understand the psyche of people is good for all investors to think, and that's why it's very important to, I guess, not just focus on the safety of a property too, because I believe that's the main reason people overpay. They get a little bit too comfortable with overpaying just because it's a security play, parking up capital play. But a lot of these people, like imagine someone one of your grandparents passed away, passed it on to a single mother, and they had 5-6 million cash, and they just needed to park it into something. They will go to one of these auctions and get ripped off, and that's something I'm just trying to call out a little bit more in the industry, because we all talk, and I talk to hundreds of agents a week, and even them question, like, how do these results happen? Just because they're a cash buyer, like, they can't achieve it themselves as well. But it's just something about the auctions that maybe people get competitive at them. I don't even know, but it does not happen in residential, and that's the really interesting thing. I don't think it happens in any other asset class. It's just this asset class, you can either do very well or go way over the top, and if you don't know what you're doing, you probably won't even know until that lease is over.
Yeah, and probably that's the reason why traditionally commercial property doesn't attract the masses, right? Maybe they're shrewd enough to go, no, it's beyond my ability, or they go the other pathway and they go, oh, I need a really good team to help me make sure I do the right stuff. And that's the reason why people buy as agents and other top professionals. But it comes back to the fundamental premise, and you mentioned this, Scott, is where do you deploy your capital for the best outcome? People invest in property generally because they want long-term value creation, whether it's capital growth or yield or both, right? Why are they doing that? Because at a point in time they can sell it and not have to work anymore, or have a better retirement, or they are looking for some sort of long-term generational wealth creation strategy. Like, it doesn't really matter what it is, right? But how well do you deploy your capital at any point in time? The same thing applies in residential property. It gets spoken about all the time. Why would you invest in that location when you can invest in this location with this asset, and you are able to achieve either of those things, or both, capital growth or rent increase or good yields, right? Not happening in commercial. Maybe that's the point. You stick on it, mate. Keep flying the flag for education around commercial. Probably one of the reasons why we've done this. And if you've got any questions to Scott, you can email him on that email, just as we said before. But I don't want to be the merchant of doom and gloom when it comes to commercial property right now, Scott. There is some concerns that a lot of people are having around it as an investment class, as an asset class, and that happens when markets change, and that's the right thing. You should be curious, you should be alert and not alarmed. You should be making informed decisions around a commercial investment. To Scott's point, like the residential market, in markets of flux and change is when counter-cyclical investors typically do their best work. So I'd say we're definitely in that right now. You just got to get in the right headspace mindset, have the right financial capability and support, and then also getting the right team around you. But there is still some good deals going on out there, isn't it, Scott? You've seen some good stuff coming over your desk that you're securing. Tell us about some.
Yeah, so as a general rule, you want to target investments with 6% net or better. And that no matter what it is, unless there's like significant initial upside, or there's just some kind of really big X factor about the property. But there's no reason why you should be accepting yields much lower than 6%. So that kind of rules out a lot of those types of investments we were mentioning before, because they're the ones that are going to suffer the greatest price falls, because the higher the interest rates go, the more the lower yielding assets get punished. it pushes more people to seek cash flow. And this is the environment we're in. We don't know how long it'll go for, but we're finding the high yielding assets have got more demand than ever. And it's just because people are in cash flow holes at the moment. They need to fix portfolios. And if they are to take debt on, it needs to be worth it. And 6% is kind of that, I guess, the equilibrium in the market where we see the demand really rage higher above that and then drop off significantly under. So that's, as of today, that's sort of the number. It may go higher. You might need 6.25% if rates go higher. But generally, the average interest rate my clients are getting are in the mid fives, like maybe 5.5, 5.75, like these types of numbers. So, that's sort of where that 6% is coming, because you're going to be ahead for the short term. Then you've got rental increases that should happen within 12 months, and then hopefully interest rates drop. So the equation will get a lot better.
So you're sort of saying it's sort of dry powder, right? So if you're buying commercial right now, you should be expecting a neutral yield, but you could be acquiring assets in this point in time if they've got the right upsides, where you'll see that arbitrage difference once rates start coming back, and that's on the basis that lenders will pass on rate cuts when they start happening, right? Like that's going to be a completely different thing. But that's the strategy at the moment, is it?
Yeah, and that's based if you're doing 100% debt, which I'd say maybe a quarter of buyers are doing that. So there is a lot of cash. Like we saved 280 billion in COVID as Australians. So there's a lot of cash out there, and that's the reason why people can accept lower yields. But yeah, if you're working off 100% debt, they're the types of numbers you need to break even. But just remember, that's not your lifelong equation. It's very important to remember that. If you can get in now, then the rental increases hit, then the interest rates drop, there's going to be a very big widening of your cash flow, and that will create instant equity. And that's the benefit of being a counter-cyclical investor. If you can look past the negativity of the market, because it is not as good now, you're not going to be retiring on the same level of debt as you would compared to last year. It's harder. But we're already seeing benefits of that. And that's that 0.75% expansion of yield we've probably seen on average around the country, which, that could be a 10% drop in price, or at least you're getting 10% better return, versus the rent you're getting. And that's significant, I think. It's like if you look back at all the big booms and busts in Australia history, like 10% fall rates are generally what's it been, and then it kind of recovers pretty quick. And if the talk of the interest rate rises keep coming a little bit quicker, then the bottom might be closer than you think. So no one knows. We definitely don't, but it'll be very interesting to sort of see when that gap starts widening for the cash flow for commercial investors.
Yeah, and would you be messing around with lease stock loans in this environment?
It's harder, yeah. So I've heard, they've gone from 70% lease stock. They still do 60, 65, but, a lot of them are doing 50% lease stock loans now. So the banks have definitely pulled the reins in. And this is the reason the market is tougher to buy in. And banks engineer the market, it creates the result, really. When lending gets tougher, that's why prices fall. It's the biggest macro factor for price growth or falls. By a fair bit, I think, because it affects the whole country. And yeah, if we see lending get tougher, which it does in downturns, it's harder to buy. But then when it gets easier to lend, that's when the price expansion starts. And I don't think it'll happen this year, or it might towards the end of the year. But it's going to be a sideways year for commercial overall, and they're the best ones to buy. And I heard. There's a lot of people out there, famous real estate agents, that say this: it's better to buy in a falling market than a rising market, because the falls are never going to be hugely significant. You're never going to time the market perfectly, but you can negotiate a lot better when it's falling because of these factors. And that's where I've been most active as an investor. And, once it starts getting red hot, that's when it's probably time to probably hold off more so than we're talking now.
Yeah, well, that's smart counsel. Scott, it's always good to get together, mate. I think we'll enjoy the 2023 and as we move into 2024 watching this market. And I think it's just a clear reminder that property doesn't work in a linear fashion. It's just not a straight line going up. Your value, it moves, it wobbles, it goes left and right. And there is, again, this particular market gives you some sense for how all the sort of macro, micro economic factors and everything else that is shaping and influencing the economy, all compounds into changing the way in which commercial property operates. So the better informed and engaged you are around it, the better you understand it, the better off you'll be. And for most of us, myself included, just go and speak to someone that knows what they're doing, trying to do it rather than trying to do it all yourself. That's probably a pretty smart thing to do. Scott, good mate. If anyone wants to have a yarn to you, just contact you through info@rethinkinvesting.com.au. Is there Facebook or anything like that, mate, that you prefer to use?
Oh, Facebook or just Google Rethink Investing and come through the main line. And always happy to have a chat about people's entire portfolios, portfolio review type stuff. And just remind them that, like you said, all years aren't great. And there's a lot of people hurting from interest rates, particularly if you've gone and, loaded up on a large family home and, prices have fallen. Just remember this is all temporary. And this is where good investors have a mindset to get through these times. And no one is going to feel richer this year than they did last year. And sometimes that kind of backwards feeling can bother people. But, next year's another year. And I think, if you get through it, hold on to your assets. I think it'll pay off.
There you go. Scott O'Neill, Director of Rethink Investing. Thanks for your time today.
Thanks, Phil. You too.
Nice one. Thanks for tuning in, everyone, inside Commercial Property. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.